Hi everyone, this is video one of 5 videos for Independent Colleges Dublin that covers the F6 mock examination for December 2014. And in this particular video we're going to be looking at question 1, which is the income tax question. So if I just take you down to look at the requirements for the question, you'll see that it's a 4-part. Very often question 1s are 4-part or certainly at least 3 parts, and this follows the fairly standard pattern, or certainly one of the themes within question 1 on income tax. And that is basically that we have some sort of case 1 or case 2 adjustment to provide assessable income details for 2 years. Part B is an income tax computation, and Part C and D are just really add-ons. The first one relates to marriage relief, and Part D relates to that area of contract of services versus contract for services, so the quite a common tax exam area. Okay, so if we go to the body of the question first, and then I'll take you through the answer to this question 1. Really what we have is 2 individuals who are married. We'll see as we flow down the question, we've got a variety of pieces of income, some quite tricky areas and some fairly straightforward areas. So the key thing that we have to remember when we're approaching question 1, or indeed any question at F6, is to try and work as quickly as we can and pick up what I would call the easy marks, or perhaps the cheap marks. So we have John and Mary. We're given some information firstly about John in relation to pension income. That's certainly taxable. Obviously there'll be a tax credit relevant to that, and it's often helpful to annotate the question as you go down, perhaps with something like TC for tax credit, just to remind you to include a tax credit when you're doing the income tax computation. And what we see for John is that there's some form of property. We'll have case 5 income here. It's a little bit tricky to deal with because it's dealt with in on 2 separate parts. We see that he purchased the property in March 13, and not surprisingly a loan was taken out, a very common area within case 5 questions, particularly when there's a residential element, and we know that there's going to be some sort of restriction on the interest on that. What we have is a ground floor and upper floor, with each of the elements barring one being rented out. Okay, so for the ground floor, which is commercial, we have a full year's rent, and they generally tend to give you the rental income annually, and it's highly likely that not all of the rent will be included within the income tax comp. We know that a key issue for case 5 income is the date of first letting, and that's why that date of 1st of July is certainly significant. We'll also see that as per usual they include a premium, so we need our formula for that. We see that the upper floor is split into 2, again a relevant date here for first letting and a rental amount, so it looks like we've got 6 months in the year, and we see that apartment B is still vacant, so basically we've got an adjustment to make in relation to expenses for apartment B and indeed the other 2 elements as well. In relation to expenditure, the common tricks here obviously relate to fractions and prorating. So the key thing you've got to be aware of is that what I mentioned above in relation to first letting date, it looks like there's 6 months in our tax year that's relevant. And what you'll see for the most part is many of the expenses won't cover that 6-month period. So we'll see in the answer there's a certain amount of prorating required. These last 2 here, we sort of either know them or we don't. They're one-off payments, and certainly, as I've said over on the right-hand side here, really just making decisions on these types of things fairly quickly is important, a little bit like we would perhaps with a case 1 adjustment, whether or not the expenses are allowable or disallowable. We have some issue here with in relation to other income. Again, this is something that the examiner will throw in from time to time. We either know the rule in relation to work of cultural merit, i.e. that 40k de minimis level, or we don't. But certainly we need to make a decision as to whether or not it's taxable or not, that 45, so we're either going to include it completely, or if we know the limit, we can deduct that. Invariably within the question 1s, there's going to be some element of self-employment, perhaps base of assessment, and we know that the areas of base of assessment that we need to look out for are commencement and cessation. Okay, and in this particular case, we're dealing with a cessation. They do throw in a little bit of information here in relation to withholding tax. Now, again, it's not overly difficult. It's just that this amount has been included and there has been withholding tax deducted at 20%. And we should really know that rule and know that that's a credit to be included down at the bottom of the computation. Moving down the page further, we're just given some basic information in relation to her income for the final periods, and we need to apply our base of assessment rules to that. We have some CA's information, pretty straightforward. We just have some tax written down values, and we have a proceeds value. So as always, when we come to some sort of cessation, there's got to be a comparison to see if there's a balancing charge or allowance. We have several deductions here. The classic ones really pension, I would say, and perhaps less so EIS. And we just need to know where they go in the comp. If in doubt, one would be inclined to simply deduct them in some way, given that they are outgoings. Obviously, one would be inclined to deduct them if the information is being presented in this form of manner. It's just how do we deduct them, and perhaps where and exactly how, what value. Okay. We'll also know in relation to the EIS that there's a specific rule in relation to the tax relief that can be claimed, and you'll see that coming up in the answer. We have a excuse me, a restriction on year one of only 30%. Okay, so again, we'll see that within the answer. So that's really a quick run through the question itself. I'll take you through the answer now, really starting with this area and moving to the main area here that I'm going to deal with, which is part B. C and D are to a large extent rote learning information rather than complex tax work. Okay, so in terms of the answer, we know that part A relates to some form of basis of assessment rule or knowledge, and we know that it's a cessation. So as I've said here, try and be clear and have a sort of a logical flow. Essentially what we're looking to do is to come up with a figure for each of the years concerned, and we have 2 years. We have 2012 and 2013. Now, they've started with the easy one, in other words, the original assessment for 2012, and obviously that's going to be on a current year basis, so simply the 12-month period ending in that tax year. Now we know, or if we know our base of assessment rules correctly, we know that that may well be adjusted, and more of that in a moment. Now, the final year, we should know that the base of assessment is actual. So we're going from really the start of the tax year, 1st of January, through to the cessation date. And the key point here really was that fraction. In other words, we had to take 6 months out of 10 really to get our figure of 21,600. Okay, and that's really the final year done. So just do look over your base of assessment rules. High chance of them being examined, and I would have thought it's either got to be obviously cessation or indeed commencement. Now, in relation to 2012, we have a penultimate year rule, and really all that says is that we need to go back to the penultimate year and really compare actual to the original assessment. Now we know the original assessment is up here, so this calculation here is just really trying to get the relevant figures for the actual calendar year, and you'll see that they actually come in higher than the original assessment. Now here's a key point that I've seen within student scripts, which they may well do the calculations, but they don't clearly state that the HMRs or the Inspector of Taxes will revise the amounts upward because they are higher. So, as I've said, don't assume that the marker knows the answer for you. Tell the marker that there's going to be a revision. So just be careful on that. You may lose a mark, lose a half a mark for doing that. Okay. So second part here, part B, really we've got the income tax computation, and as I say in classes, there's a lot of very easy marks here, and there's some quite tricky marks. Now I'll take you through the main ones. As I say, I won't deal with every single area, but certainly looking down the comp, we know that they're married. We know that it's going to be joint assessment. So you'll see that we're just simply trying to list the income, and then obviously list the reliefs, and then indeed the application of the rates, and then the credits. It's important that we annotate our workings. So, I would say that this is perhaps our page 2, having done part A on one page. This is our page 2. A computation is unlikely to be more than one page, so our page 3 would probably be the start of our workings. So hopefully we'll be referring to page 3 within this income tax computation. Now, as I say, some of the items are easy enough. The pension is just slotted in. The Schedule D, excuse me, the Schedule D information, case 5, I'll come to in a moment. And then we have that case 2, that artistic merit income. So I'll deal with the notes in order. If we go down to note number 1, so I can give you a take on that. Now you'll see that there's quite a lot of work here. Obviously, if case 5 was to come up in your December 14 exam, it's not going to come up in this fashion, but just note the layout. Where we have 3 different parts, they're laying it out in 3 different columns. Makes it a little bit easier for them to get things right. And all that you see here is really sort of rental income in some way, less some expenses. And we're certainly aiming to get 50% or more here. And I would have thought that the rental income side is often the easier to deal with. Okay, so we'll note from the body of the question that obviously we're prorating, and you'll see, for example, that we have basically half of the annual rent here. You'll see that down below in a note. In addition to that, we've just got a prorate at 900, I believe, for 6 months because the property is rented for 6. And obviously apartment B is not rented at all, therefore no income. Now the lease premium, I'll show you that formula in a moment. Again, that's assessable income. Do bear in mind with the lease premium, we're just looking to take out of the premium any income that is assessable, and that's with short life premiums, as it were, 50 years or less. Okay, obviously with a long premium, it wouldn't be taxable for income tax purposes in any way, shape, or form. Now, in terms of the nuts and bolts here in the detail, I won't deal with all the fractions and the adjustments. What I will say is that that key issue as to the date on which the properties were first let, i.e. 1st of July, is really the key. So in essence, really across the board here, just about, we're only trying to find 6 months worth of the expenditure, because that's all that we can include. And you'll see as we go down the notes in a moment that to a large extent that's 6 months. If you can figure that out, that will get you a substantial amount of marks, as long as you know what is at the bottom half of that fraction, because it isn't necessarily 12. I think in some cases it's 10. Okay, so more of those in a moment. You'll see here we've just got a couple of items here. I didn't touch on them in the question, but we either sort of knew the rule or we didn't. And as I said on the body of the question, if we see one-off expenditure, we just really have to make a decision. In this particular case, the registration fee was allowable and the NPPR wasn't allowable. Spending a lot of time deliberating is probably not a good idea. Okay. So just a quick look at some of the items of the expenditure. The income, as I say, is normally a lot quicker and easier to deal with. It's easy to get that right more often than not. It's either just multiplication or perhaps one fraction being applied. The premium, as I've said, we're just stripping out the income element. We do need to know that formula. We need to be able to apply it quickly. We could have multiple premiums in the question. Bear in mind, part years are irrelevant. It's just full years that we're interested in. Okay. In terms of the interest and indeed the rates, as mentioned earlier, it's very much a question of really knowing the top part of that fraction. The only twist here was that issue of the 75% allowability for the loan interest in relation to a residential apartment. That is a very, very common trick. Try and remember that. And marks for not too much at all. It's just simply remembering that there's a residential restriction on loan interest. Okay. In terms of the insurance, really, what again, we're talking about 612. So I think the way that they provided it to us was a little bit unusual, because I think that it was for the 28th of February 2014. So that may have confused some students. But at the end of the day, only 6 months is going to be relevant, and obviously irrelevant if the property isn't rented in any way, shape, or form. Okay. So just going back up to the top here. what we'll see is that, a couple of tricky bits in order to get down to this area of net rental income, but certainly several marks to be had for not too much at all. So the key is to work quickly, make an attempt, and then really get out of there. Okay. So that's the rental income dealt with. In terms of the case 2, as mentioned within the question itself, is really just a rule. We either know it or we don't. Certainly, if you've made the mistake of perhaps not including it or including all of it within the mock, do try and remember that exemption limit of 40. Not a very common thing to include in question number 1, but it has been included here, so good idea to remember it. Okay, so that's really notes 1 and 2. I'll just go back up to the computation itself, if you'll just bear with me. You remember what we're trying to do here is just really slot the figures into the computation really as quickly as we can. So we've got down to Mary, and we know from the part A of the above question that really that we had that figure of 21.6 for the final year for 2013. And in terms of the capital allowances, I'll come to that in a moment. Remember that all we're looking to do is just deduct obviously capital allowances, or possibly even add in a balancing charge if that's relevant. Okay, so in terms of the capital allowance as well, I think what we had was unusually is a fairly straightforward capital allowances calculation, where we were simply provided with a tax written down value and indeed a proceeds. And really all that we're looking to do is, compare the two. And what we have here is a difference of 2, which is obviously an allowance that works in our favor. So fairly easy marks there. Okay, back up to the comp again. Apologies that I have to keep going back and forth, but no other way to do this. So we have, we're now down to this figure of 66,090, and really here we see several different reliefs, and I'm going to focus in on 1 or 2 here, just the pension and the EIS. Really, the pensions are very, very common. They're extremely common, and I would suspect that the more common approach to dealing with a pension issue is in a case where the limits are in some way exceeded, as is the case here. And really, what we're trying to do, obviously, in the first instance, is get the NRE, get the net relevant earnings, and then allow for, based on the individual's age, the amount that's relevant based on net relevant earnings. So in this case, we had to restrict to 7840. And I think that's the most common approach of the examiner. It could work both ways. Also remember the cap on NRE of 115,000. So perhaps with the NRE is 150, that would be irrelevant. We'd be applying the percentage to the capped amount of 115. Okay, so that really deals with the pension. Tables are important. Obviously, age is important for Mary as well. Okay, now in terms of the EIS, we know that it's a deduction of some kind, or at least I hope we do. We know that the amount invested was 10, and the key point really was the restriction relief in year 1. We know that the full marginal relief, i.e. 41%, is available as long as the shares are held for 3 years, but in year 1, just 30. So watch out for that. And the way they've done it is to simply apply a fraction really to the amount of 10,000, giving us 7,317. And that allows for, in effect, that 30% element. Okay, so those are those 2 issues. We did have a carer payment. Note that the individual wasn't employed in any way, simply a payment out to a carer for her care. Okay, so really that gets us to here. We've got some credits which hopefully you're familiar with and fairly straightforward. These are very much easy marks, as I've mentioned above, and try to remember that there are marks available for really quite small, straightforward items. Okay, so that's the conclusion for question 1, and question 2, 3, 4, and 5 coming up shortly.